Welcome to the Slash Tax Podcast, where we uncover smart strategies to reduce your tax burden, unlock federal and state incentives, and invest in tax-advantaged opportunities to build lasting wealth. I am your host, Heidi Henderson, and today's episode is a powerful one. We are diving into the world of oil and gas investing. This is a sector that not only offers high upside potential, but also some of the most compelling tax advantages in the entire U.S. tax code. Joining me are John Engel, Executive Vice President, and Steve Ziemke, Senior Vice President of Gulf Coast Western. They are a leader in domestic energy investment. Their decades of experience and transparent approach to structuring joint ventures has helped thousands of accredited investors benefit from both passive income and powerful tax strategies. This is a strategy that I personally have used to help diversify against some of my other investment accounts and some of my real estate investments as a strategy to bring in some tax benefits and just an alternative source of passive income. In this episode, we bust myths, break down risks, and get specific about how oil and gas investing works and how a change in administration could affect future opportunities. If you're an investor, an advisor, or high-income earner looking for your next strategic move, this episode is for you. So let's dive in. So without further ado, let's welcome John Engel and Steve Ziemke to the show. John, Steve, thank you so much for joining us today.
Thank you for having us.
Thanks for having us.
Absolutely. Okay, so John and Steve, to start off, can you give us a brief overview of Gulf Coast Western? What types of oil and gas assets do you guys develop? Do you manage? And how do these projects fit into kind of the broader energy landscape? And right off the bat, let's hear exactly what you guys are doing.
Yeah, so Gulf Coast Western was founded in 1970. We did primarily our own exploratory drilling, and then in 2007, we started forming joint venture general partnerships. In essence, what that does is it allows us to diversify, and we're essentially sharing in the risk and we're sharing in the reward of oil wells. So from 2007 to 2018, we did primarily exploratory drilling, which is the riskiest type of drilling. And we pass on the tax advantages that are written into the U.S. tax code for exploratory drilling, and we pass those tax advantages on to our partners that want to participate with us in those wells. And you know, the tax code was written so that for us to develop our own natural resources and develop our own natural resources, the U.S. government understood that there was risk involved. If you go out and you spend all the money to drill an oil well and you buy all the seismic and you do everything that you can to make sure that an oil well works, but you drill a dry hole, that's a huge expenditure with zero return. And so the government understood those risks, and they put into place into the tax code where you can write off through intangible drilling costs and intangible completion costs the majority of those expenses in the year that those costs were incurred. So in 2018, we were presented with an opportunity to get into infield development, drilling wells in proven areas with a lot of production, drilling horizontal wells in these major resource plays in the country. And so in 2018, we started drilling those horizontal wells with smaller independent operators. And from there, it's blossomed year over year. And now we're working with, you know, the biggest names in the industry, drilling the wells. The benefit for us is that we've taken the major risk portion out of the equation, which is the risk of drilling a dry hole, because we're drilling with major operators in proven areas of production. We've turned that the risk of drilling a dry hole, essentially, we've taken that out because we drill multiple wells in each joint venture that we form. However, those same tax advantages still apply. So we can drill we can drill a dry hole and go exploring for oil and maybe have a 20% chance of success, or we can drill in the best field in the country and drill the best well in the country, and we still get the benefit of those same tax advantages. And we pass those along to our partners. And our partners obviously are a lot happier with our success since 2018, because dry hole calls are not fun. I got to the point where I hope there's no geologists listening, but I started viewing geologists worse than weathermen, because they can be wrong more often than not, and then they're on to the next project. Now, by drilling wells with these major operators, I get to rely on multi-billion-dollar budgets, teams of engineers, teams of petrophysicists in the best fields in the country, and I get to reap those rewards, and so do my partners.
Wow. So, John, what is your role in the company, and how did you come on board with Gulf Coast? What's your background with how you've gotten here and are I guess running this company?
Short answer is life is a crazy ride. I grew up in Houston, Texas. My entire family was in the oil business in some way, shape, or form. I didn't want to be in the oil business because my family lived through the 1980s, oil glut and that fiasco. So I went into finance out of college and ran stock brokerages and worked in bond brokerages, and just through a circuitous route ended back up. Gulf Coast Western was opening up an office, and the opportunity presented itself, and they asked me what my background was, and I said finance and oil and gas, and they're like, well, that's kind of what we do. Maybe you should come in and meet with us. And so I've been with the company since 2009. And then in 2017, I was promoted to Chief Operating Officer with Gulf Coast Western.
Fantastic. Well, congratulations. And Steve, tell us a little about yourself. What's your role with the company, and how did you dive into the oil and gas field?
Kind of the same thing. I'm executive vice president in sales, and I've been with the company since the end of 2007. And I've grown with that through, like John said, the hard times, and now just a turning point for the company back in 2018. And prior to that, I was in insurance. Okay. I started insurance sales. I worked up to assistant vice president, operations, and customer service, underwriting, sales, just a big background. That through layoffs, whatever that ended, and I said, I'm going to get back into sales. And I started in oil and gas, and have been here since then. Fantastic.
Yeah. Well, in full transparency, I have to tell listeners, I am personally an investor with Gulf Coast Western. And as my sister, my partner as well, is also an investor for a number of years. And that's one reason why I wanted to have you guys on as a guest. This is a little bit of a different topic than what we oftentimes talk about on this podcast. A lot of times I'm focusing on the CPA industry and what's changing and how to be proactive. So the reason that I really wanted to have you both here is because of what you're doing, and because of some of the significant tax advantaged structures that exist in the oil and gas space, and really understanding the application. I mean, this is one of the only investment opportunities for an accredited investor that can offset active income. And there are many limitations. I mean, we talk a lot on this podcast, and at Engineered Tax Services, we deal a lot with cost segregation with real estate investing, and dealing with passive versus active rules and what investors are looking for. And again, looking at this, it is one of the very few investment opportunities that have those tax benefits associated with it. So wanting to have you guys on and really dive into the industry, into your company specifically, but also really understanding the industry as a whole. Like oil and gas, to me, I've been in tax consulting now for 15 years, in the accounting space for almost 30 years. And oil and gas was always, even after having gone to multiple oil and gas conferences with some big players in the space, it was so overwhelming. It feels a little bit like it's too good to be true in a sense. The risk is difficult to kind of understand. And I actually lend myself more towards the ultra conservative side. So I like to overanalyze things before I jump into certain investment opportunities. All right, so let's first, if you wouldn't mind, dive into the tax benefits. Can you explain some of the key tax incentives that are available, like the depletion allowance and other credits or deductions, and why these are really particularly attractive for investors?
Yeah, Steve, you want to tackle that?
Sure. The IRS allows, and back in 1986, the Tax Reform Act is when this whole kind of it took a turn for the positive in terms of promoting domestic production of oil and gas to become more self-reliant as a country. So those incentives came in there. So the biggest thing is that it's great to get a tax deduction, but if you don't have returns, then why invest to get the deduction? So what's been a turning point for us is the revenue that comes in. So there's two benefits. There's benefits going into the investment of writing off the investment 100% eventually, but the first year is about 85% of that investment is deductible due to the intangible drilling and intangible completion costs. Those are the labor and the more labor-intensive activities that the IRS allows to write off. The rest is more equipment that's depreciated over 5 years or 7 years. Going into the investment, we look at nice return potentials based on comps around us, kind of like real estate. You got to be in the right area with proven production. So we have that going for us, but we still get the deduction, like John said. On the revenue coming back, the depletion allowance, like you mentioned, Heidi, is 15% tax-free income. So every $10,000 that we send a client, he saves about $1,500 that he's not even paying taxes on. So the rest is taxed as ordinary income, but that's okay because we're making money, we're getting the deductions on the front end, and eventually all of it, and then we're getting some tax-free dollars coming in back to the investors. So it's very unique in the sense that it's outside of the markets. It's treated differently in terms of the ability to write it off, unlike say a stock where you have a $3,000 maximum if you have losses, and if you have gains, of course, you can't write it off. So that is unique in the sense that it's alternative investments, and that complements everything else out there. So very, very unique in that sense.
Yeah, absolutely.
It's also one of the few investments out there that, for if you were to invest in a stock, you're really only making money in that stock if that stock goes up and if you decide to sell it. Other than that, it's paper, unless you happen to be in a stock that pays dividends, and good for you if you are. But in this case, you take our joint ventures are built around a group of oil wells. We don't do single well projects. We have in the past, but I like to build in diversification in every partnership that I build. So not only is it multiple wells, but it's multiple miles of pipe that are placed into the oil. It's all about surface area, and most of our wells are 2 miles each. So, for instance, if I have an 8-well project and each well has 2 miles of pipe that's drilled and placed into the reservoir, I've got 16 miles of pipe in the oil, where most vertical wells might only have 50 feet of pipe in the oil, depending on how thick that reservoir is.
Wow.
So I mitigate the risk by having multiple wells. I mitigate the risk by having multiple miles of pipe in the oil. And from those wells, depending on how Mother Nature cooperates with the engineers, the oil that is produced from all of those wells is sold, and it produces a monthly revenue stream back to our partners that we send direct deposited back into their bank accounts every month on the 15th or the 20th of the month. At the end of the year, we usually see a rush because people meet with their accountants and they're like, oh my gosh, I would rather put some of this money that was going to the government, which is an absolute dry hole. You're not typically getting a return on your investment with the government. Take some of that money, put it to work for me and my family, save some of those tax dollars from going to the government, and put it into a vehicle that can pay my family potentially for the next decade or more. So that's really what we do. We have taken a vehicle that is put in place by the government, de-risked it by multiple wells in proven areas. So we really mitigated the dry hole risk. There is still mechanical risk because we are putting, in most cases, these wells, after it's all said and done, each well is 20,000 feet thereabouts between the depth and the lateral. And you can run into mechanical issues, but we're talking about a 2%, figure of wells that might not work versus 98% that work. I'll take that risk in the oil and gas business any day of the week. So that's, again, just in case of that 2% risk factor as far as mechanical risk. That's why we build in the multiple wells with multiple miles of production. So we try to structure it so that the monthly revenues, the tax advantages, the depletion allowance all work together for our accredited investor partner.
Fantastic. Yeah, I appreciate the background because, in many of the conversations I've had, when I was doing due diligence to look at investing with you guys, I was working with a number of my CPA partners and people that I trust and appreciate on the due diligence side. And risk was definitely probably the number one thing that was mentioned, that was brought up, and really wanted to dig into how the risk was mitigated. Before, I do actually have a couple more questions on that, but I want to circle back to what Steve was saying in really defining the tax benefits associated with it, and to provide some generalized examples. Because for me, I'm like, come on, let's get down to the nitty gritty of how this all calculates out. And I want to talk about this as well, because when we look at the tax benefits and we look at how much we could potentially invest, the other thing or misnomer that I had with oil and gas is that this is for people who have 10, 15, 20, $100 million, and they are investing millions of dollars and, diving into, drilling their own oil wells and getting into oil and gas. Like, this is big money. It seems like you guys have actually built a situation or a structure where this is more attainable for the average person, still accredited investors, but the average person to be able to invest in one of these partnerships. Can you talk just a little bit about, why, I guess, you have lowered the threshold for that entry point, and what is that threshold?
Well, it's not necessarily that we've lowered the threshold. It's really a matter of realizing that everyone has different tax needs, and that's one of the reasons, we don't give tax advice. We rely on an individual's tax advisors or accountants for that. But it really depends on any given year. Every partner has a different tax need or has a different income level. A lot of our partners are either retired or they own their own businesses, and from year to year, it could be completely different. To your first point, we have some partners who invest in every single project that we prepare, and then we have some partners who might do one. They might do one a year, they might do two a year. And we try to structure it so that it is an achievable goal as far as, providing a nice tax advantage instrument for them that can help them with their tax situation in any given year. But there's no limit on how much a partner can participate in on any given project, other than as long as the interest is available in those wells.
Yeah, that makes sense. Well, and as an example, using a small example, let's say an investor puts in $250,000. Steve was giving the example of having roughly an 85% deduction year one for the costs of your drilling and the expenses going into that. So with a $250,000 investment, am I correct if that calculates out to roughly about a $212,000, $213,000 deduction in that year, correct?
That is correct. And in some cases, in some cases, a partner who might be in that highest tax bracket, a reduction, if they're in that $600,000 range and that $250,000 investment in a joint venture, that reduction in reported income can drop them down, not only save them the tax money, but it might actually drop them down a tax bracket or two.
Oh yeah, that's a great point. Because if we use that same calculation, $250,000 investment we've got a deduction of about $212,000. In a top tax bracket of 37%, that equates to about $78,000 in saved taxes. That is not including state. Are the states also in the same, do they have the same rules? Like I know California in a lot of senses does not follow some of the same rules as federal. So do the states still allow for the same deduction that we see on the federal side?
Steve, you want to handle that one?
Yeah, I think for the most part they do. It drops, it follows down to the bottom line. Some states do not, like California just, I think last year changed their rule. But so it might be limited or not allowed for the state. But I would say most states, it does carry down. So if you're in the 37% bracket plus 5 to 10% state, it starts to really add up.
Yeah, absolutely.
And,
or 12% state.
Yeah.
I mean, we're looking at in California and New York, some of these high tax states with high income earners who are paying up to 48% tax. A $250,000 investment could save them $100,000 in taxes. So really, you're really investing $150,000 because $100,000 comes back from the tax aspect, but then you're getting returns on that entire $250,000 investment. And that's just a small example, but I like to quantify that again because I like the tangible numbers. It's accountant in me.
No. To the California point, if you're in the highest tax bracket in California federally, and then you have the 13% income tax, if you think about it on a time perspective, those Californians in that highest tax bracket are working pretty much to July for the government in some way, shape, or form before they're ever making money for them or their families. So they just adjusted that, I believe, last year, as Steve was saying, because they realized how much money that was being saved from going to them. So they made that adjustment. Right. But most states do allow that deduction to come off of the state income tax.
Yeah, that's amazing.
Well, we do. Sorry. Go ahead.
No, go ahead, Steve.
I was going to say, back to your point about the different types of investments. We have core projects, which are right now, our current one is 8 wells. And so that allows a person without any oil and gas experience in investing to come in at a level below the $250,000. And then after they see how it works, how we operate, how we communicate as a company, the revenue that starts to come in when they get their K1 the first week in March for the deductions, they start to see more how it works, and then they can go into those bigger projects like you mentioned, where a partner can put in $250,000 into a 30 or 40 well or 25 well program and be immediately diversified, because like John said, with the horizontal wells, we have found that it's not if you hit, it's how much. And so you're just like, stocks or real estate, you want to have a group of wells because some will be below, some will be average, some above. So a partner, we offer a lot of options for partners based on their desire to immerse themselves into more diversification and bigger tax advantages too,
Got it. Okay.
And to that same point, again, diversification on any given well pad, if I have 8 wells or I have 16 wells, on any one of those, there will be a well that is the top performer from that pad, and there will be an underachiever on that pad. And so that's why we look at averages and everything that we do. So if I look at it, I don't ever want to just rely on the top producer on a pad. I want to have a blended average. That's where that diversification comes in. So it gives us a good idea of what the wells are possible or what they're capable of in a realistic manner, rather than taking the top one or the lowest one.
Yeah. Okay. That makes sense. Gosh, I have a lot of questions. So the next one, John, actually circling back to risk before I want to talk about reward. What other risks would an investor need to be aware of or might be of concern? And I will preface that with saying that I've had multiple questions about the potential for operational risk, for risk to the partner, which is why this actually applies to ordinary income as being active, is because you are actually a partner in this structure. So how do you mitigate risk that could be carried or could apply to the investor as an active partner in a oil and gas project like this?
There's several ways. Number one, as far as the from the drilling standpoint, we would be the top of the totem pole. And so if our operator, there's multiple chains of insurance as far as, to begin with, from the drilling and the completion side of things, all of those multiple layers of insurance, and they do not allow a single person on a pad unless it's unless it's an employee or someone who is under one of those insurance policies. So, it's a lot of equipment. It's all run by diesel engines, and bad stuff can happen. And all those employees are covered under those insurance policies. From a drilling risk standpoint, we're not going to, if I see an area of wells that it is like a newer part of the field, I will avoid it. If it's an expansion part of the field, I will look in more detail. But I typically only get into wells or agree to participate in packages of wells where there's good production in close proximity to where these new wells are being drilled. And with each well drilled, the technology improves over time. So, a well that was drilled in 2017 would be an antique as far as I'm concerned, technology-wise. It's just like your iPhone. It's constantly changing and being upgraded, and they're sending updates. The same thing is happening in the oil field. Or if you look at aviation, the Wright brothers were flying a rickety canvas-covered wing airplane in the early 1900s, and now we have F-22 Raptors that can go, Mach 2. It's the same leaps and bounds. If you look at the oil industry over the same time period, very similar improvements in technology have happened over the same amount of time. So from the operational standpoint, our partners are protected through multiple layers of insurance and an umbrella policy that we name each joint venture under that's participating in those wells. And then we have not, we're coming up on 300 or 400 wells. I can't keep track because they're all drilling so fast, but since 2018, we have not drilled a dry hole.
Wow.
In these fields. So huge turn as far as, the risk. Our old projects, when we were exploring for oil, the first thing out of our mouth would be, this is oil and gas. Before I go through $1 of why economically we're putting the bit in the ground, before I go through any of that, you need to understand this is oil and gas, and it is risky. If we go out and drill a dry hole, you lose your money, and all you get is a tax deduction. Do you understand that? And now it's more along the lines of the risk has been mitigated. Your main risk now is commodity pricing. COVID is a great example. We had some phenomenal wells doing 1,000 barrels a day that were turned on right as COVID hit, going into $35, $25, $10 oil. We were ecstatic about the production of those wells, but no one saw that pricing. And, the one day when it was negative $38, no one saw that coming. It was not fun to watch, especially with some really good wells that would have paid our partners out immediately. You contrast that, we've had other wells where prices were in the $120 range. And on some of those wells, our partners were paid back in the first 8 distributions.
Wow.
And made whole, not including the tax advantages. So it's really, that is the main risk as far as, commodity pricing. Right now, we've seen a nice, steady $75 range, given all the turmoil in the world, even with, Joe Biden going to Trump, Israel, Iran, all of those things, Ukraine. It's stayed pretty much in the $70 to $75 range. I think as far as the pricing standpoint, we're in a good spot right now, but that is one of the risks to consider. You will always get the tax advantage. The commodity prices is not a known factor other than it's going to go up and it's going to go down. But as far as a dry hole risk, I just use the 2% that figure because that is the risk. You could run into a mechanical issue, but it's few and far between. These engineers have it down pretty well down to a science up there. And the other factor would be Mother Nature. You are still drilling a hole, 7,000 feet down or 10,000 feet down, and then putting a lateral in, 2 miles in the ground. And you're hoping that all the science works in your favor and Mother Nature cooperates. And sometimes she doesn't, but that's few and far between in these fields.
Well, yeah, it's so fascinating. And for listeners, when I had initially chatted with Steve, they sent this phenomenal marketing package with this really beautiful little video that shows some of the actual drilling activities and some incredible diagrams of how the process works. Very fascinating, because this is completely out of my wheelhouse. But I think it's so interesting. So to that end, John, talking about the risk versus reward, talk a little bit more about, two things. One, it's difficult to pin down the potential payout or payback, the ROI. Okay, I'm going to make this investment. Yes, there's the tax benefits to it. Obviously, there can be a range subjective to what the actual benefit will be as it relates to the payouts and what's being drilled. But additionally, this transition to the Trump presidency, it has sparked a lot of questions about oil and gas pricing and policy changes. What is your perspective? I mean, obviously, you don't have a crystal ball. We all wish we did. But what is your perspective on what we're looking at for the next year or 2 years, especially with tariffs and all of these discussions we're hearing every single day? Help us just kind of, if you can, quantify a little bit of what the potential returns are and then how that's impacted by some of these legislative changes.
Good question. So what I try to do when I'm putting a program together is I try to structure in based on the analog or the key wells in close proximity to where I'm drilling my wells. I try to get a good basis for what those wells are capable of. What can that rock in that particular reservoir produce at over a consistent time frame? And I usually look at a 2-year average of how much oil and gas those wells produce. From that, I will take the interest that we have available to participate in those wells, and I'll build a program based on, right now I use $75 oil as a basis. And I try to build in a middle to high double-digit annualized return, not including the tax advantage. Mm-hmm. And then overall, these wells, I don't care what engineer you talk to, you'll get a different answer, but how long will these wells run? The consensus is 15 to 25 years. Several operators will put in writing that they expect a well to produce economically over a 25-year period.
Wow.
So, but the bulk of those returns are going to be early on in the production, the first 5 to 7 years, because that's when the pressures are the greatest. Again, Mother Nature's pushing this up to the surface. We're taking advantage of it and selling it at the surface. So from that perspective, I try to build in a depending on how much Mother Nature is eventually going to give us, and we won't know until 10 or 15 years down the road. And I try to take the conservative approach and I try to take the optimistic approach. So our tables are calculated. All of our tables start at 0. That's the worst case scenario. None of these wells work. We didn't make any money. From there, I try to build in different scenarios as far as keeping the current, the same price at different production levels and different total production levels. So overall, I'm shooting for a 3 to 5 to 1 overall return, all the while the original investment was a 100% tax write-off in the year that was figured in. So if a well, as Steve was saying, if a well really in year 1, we tell our partners to really look at the tax savings as your initial return, because that's what you're going to be saving on April 15th of next year. So if you're in the 37% tax bracket, consider that, the first amount of money that you're making because you didn't write that check to the government for that amount. But around that same time, you should start to see the production revenues kick in. And then the following year, you'll get your K1s and everything that goes with that. So that's how we try to build it in. Each project, if it's, I understand the wells that we're drilling now are ridiculously more expensive than the wildcatting wells. Mm-hmm. If you were to drill a wildcat well, I might have a 12 or a 20 to 1 overall return potential, because we really don't know what we have until we hit it. If we hit it big, the potential's there, but that big zero at the bottom is also there. You get a tax deduction. Those projects are very cheap to get into because there's not known production in the area. So your leases are easy to get. You're drilling a vertical well to test and see what you have. So they're comparably much cheaper to drill a wildcat well, but your success rate is nominal. These wells where the proven production is, where Oxy and Chevron and Anadarko and all these big companies are drilling these wells with huge success, are much more expensive to get in. So given that, I try to structure it where the partners still see a very reasonable and respectable monthly income potential, and over time, a nice, 3 to 5 to 1 overall return potential, not including those tax advantages.
Okay. So just to clarify, a 3 to 1 or 5 to 1, again, if we use that same example of a small $250,000 investment, you're saying that in the life of that partnership and those wells that, diversified wells within that fund, or that LLC, that a $250,000 investment could pay out somewhere between $750,000 to $1.25 million over the course of that. You're saying 20 to 25 years, since that's the typical payout, correct?
That is what we're shooting for. Yes, ma'am.
Okay. And what percentage of that, you said they typically pay out the most in the first 3 to 5 years, since that's when they're most highly producing. Mm-hmm. What is if you look at 20 years, what is the percentage of revenue that comes in that first 3 to 5 years, as opposed to, 20 years is 100%. What's the percentage you usually see paid out in that 3 to 5 year period?
I'm totally dependent upon Mother Nature and commodity pricing. We, like I was saying earlier, we have some joint ventures that have paid out or gotten our partners their money back in 12 months, in 8 months, and some that have taken 3 years. It just depends on when they came on. COVID, we started drilling these wells in 2018, and COVID was right there in 2020, 2021. So that threw a wrench in the gears, but the wells were still successful. Everybody understood the pricing. No one had ever seen pricing do what had happened during COVID, when no one could drive cars.
Yeah.
But we with Trump in office, with it, really all he can do is open up more areas to drill. So from a pricing perspective, yes, we might see prices dip down into the 60s for a while. But the thing to keep in mind is all of these operators who control the drilling of these wells, they were all kind of caught with their pants down when oil prices went up to 120 and they flooded the field with drilling rigs. And then oil prices took a dive during COVID. Where we're drilling most of our wells, there were 25 drilling rigs in Weld County, Colorado. Now there's a very consistent 10. The operators, just because oil prices pop up here and there, are not going to go flood the field with drilling rigs again without being very methodical about it. So Trump could say, hey, you can drill wherever you want. That's great, but the operators aren't going to rush out there because they're constantly watching, the oil prices. So they're not going to go out there and you're not going to see drilling activity shoot through the roof because Trump's opened up, different areas where federal permits were, put on hold. The operators decide when to put those rigs, and Trump can tell somebody, go drill the wells, but he's not the one spending, $7 to $12 million to drill those wells. The operators are. So they are the ultimate control there. And they're only going to do things based on them getting a good return on investment, just like us. The operators we work with, they control everything about those wells. And that is a beauty of what we do by joining our joint ventures into these wells that are operated by I'm not going to name drop, but the biggest names in the industry. We're able to rely on those companies and their expertise. And I haven't had to talk to a geologist in 7 years, and we haven't drilled a dry hole in 7 years. So I'm able to rely on that expertise and their budgeting and how fast they're going to drill wells. from that perspective, I won't put wells into a joint venture unless I have something in writing from the operator that drilling is going to start within a reasonable amount of time. Because it doesn't do me any good to build a partnership around wells that aren't going to drill for 2 years. Now, sometimes operators move the drilling schedules around. We don't have any control of that. I'm operating based on what they sent us in writing. I don't think we're going to see a big spike in oil prices. I also don't think we're going to see a huge decline in oil prices because all of the United States operators understand that if they go out and start drilling a bunch of oil wells, Saudi Arabia can just turn on the taps and flood the market with oil. And then there they are sitting there spending all this money to produce oil when it's being flooded into the country.
Wow.
So everybody's going to be very methodical and very careful about what they're doing going forward.
Yeah, that makes sense. Well, and your explanation is taking me exactly to my next question that I wanted to ask you, and that's about how you differentiate yourselves from other players in terms of mitigating risk and maximizing returns. What is a differentiator? Why Gulf Coast Western? Because there are a number of oil and gas companies. I know I've really appreciated getting to know you all and the due diligence I've done. I do feel like you guys have some differentiators, but will you share those with listeners a little bit about what those are and why you guys?
The main difference, I would say, is that our CEO is a very astute businessman. He's run multiple other businesses. He's taken businesses public from nothing, and he always does the right thing or attempts to do the right thing by our partners. That being said, the operators that we choose to work with, and I mean that, choose to work with, are well-funded. They're either very well-backed, private equity-backed companies that in some cases might be more valuable from a financial backing standpoint than a lot of the public companies are. But we choose to do business with them because they can pay their bills and they do what they say they're going to do as well. A lot of companies, and there's nothing wrong. I don't know of a bad scenario where a good company gets invested with a mom and pop type operator who has something happen on a well and they can't put forth the money to fix the well or do what's necessary to get the well back into production or boost production. That's one thing that we have gotten away from because we used to drill, vertical wells in Louisiana and South Texas and Mississippi and Alabama. And the operators were, all levels of financial backing. But in this case, we're working with the majors and we're riding their coattails. And in a lot of cases, just through osmosis of us being in the field and word getting out that we pay our bills on time and we're good people to work with and be good participants in the well, we're getting deals sent to us directly from these major operators.
Oh, wow.
Yeah, and the thing is, too, is that with the way our CEO works, he looks out for the partners. And so John and our CEO gets a lot of, deals coming at him. And it's, what is the proof of production around them and what's the timeline so that the return on investment starts reasonably soon versus, like John said, waiting for a well to drill 2 years. We might come back to that one later, but we want to put together projects that are beneficial to our clients from a diversification standpoint and timeline too.
Yeah, the timeline's important because if operations don't start by March 31st the next year, that puts those tax deductions in jeopardy for that year. They would just get pushed to the next year. So we try to structure it so that everything's timely. And that's one thing, to understand in the oil and gas business, it's not a get rich quick overnight scheme. It is the wells take, from start to finish, a lot of time to put together between permitting and getting all the different loopholes that these operators have to jump through, depending on what county they're drilling in, to get all that put together, schedule the rig, drill the wells, get the wells into completion, and then place them into production. That can take, a year to 6 months. So that's why I try to structure them as far as timeline. I want to put together a project where the operations are set to begin very soon so that the partners aren't sitting there going, when are the wells going to drill? When are the wells going to drill? because they do have a timeline. And once a well goes into production, it takes some time because the oil wells start producing, and it takes, a month to get a full 30 days of production. And those oil sales are paid on typically a 60-day contract. And the natural gas produced from the wells is typically paid on a 90-day contract. So we get those revenues from the operators typically 4 months down the road from the month that the wells were producing. So it's just, but once that happens, it's a monthly revenue stream. It goes out every single month that those wells were in production. There's a lot of moving parts. We try to simplify it. And you were saying, it's fascinating and it's mind-boggling, and it is. And I go up to the field a lot, and I learn something every single time I go up there. And I love it. And I don't know how many times I go up, I'm like, wow, I did not know that they did that. Again, it's constantly changing, but the amount of work that goes into these is tremendous when you're talking about some holes in the ground that are going to be, making fluid that we sell and then generate revenues. All the inner workings are just, they're mind-boggling.
Yeah. Well, it's been fascinating. I mean, I really appreciate, first off, the communication. I'm getting constant updates of what's being drilled. There was a new drill or a new well drilled here, and this has gone into service, and kind of updates on what's happening. And then I was also pleasantly surprised with how quickly we started to see payouts on some of these investments. So, you guys definitely have a very streamlined process for making sure that you've got the infrastructure in place that's allowing for those tax deductions in the year of investment, and then having a relatively quick payout of distributions, again, that come monthly, which also I think is really surprising with how you pay that out, with the consistency and the easy automatic deposits. It's pretty amazing. Before we close, I want to get a final piece of wisdom for our audience from both of you as it relates to not only diversified investments, how to really look at having diversification and how this can play a part in that, but also what advice would you offer for anyone just starting out to explore this asset class, and especially in terms of balancing the promising tax advantages with risks? Do you have any thoughts? I mean, I know you guys have a little bias since this is what you do, but I would love your perspective and love for you to share that with our listeners.
Go ahead, Steve.
Yeah. So for the right person, this is an excellent vehicle to diversify one's investments and to put tax strategies together. It's for accredited investors, so they have to either have $200,000 a year income and or $1 million net worth without their primary house. So for the person that has their financial house in order, this is a way that they can take a certain percentage of their liquid assets, and that would be a combination of stocks, bonds, IRAs, whatever that number is, to say, okay, is it 50,000, 100, 300, and have them build their portfolio of oil and gas. And that's my job for my clients, is to not just put them into 6 or 7 or 8 wells, but if they're capable, is to expand that so that they're protected among the variation of the wells, and also to put their tax strategies to work. And the same thing, we work with a company called Entrust, and we can do set up self-directed IRAs and do IRA rollovers. And so it's a non-taxable event, the rollover, and you don't get the tax deductions because it's a traditional pre-tax IRA. But then the following year, people do Roth conversions and save substantial dollars there, and then the money grows tax-free on a Roth. So there's different vehicles for the Entrust to set up self-directed IRAs. That's a decent percentage of our business, actually.
Oh, wow. I had no idea. I learned something.
Oh, yeah. The IRA is thank you, Steve. That's a very good example of some of the things that are available to the partners. You invest through a traditional IRA, which most of our partners, most accredited investors, 95% of them have IRAs that they're really not touching. And they're really not generating a lot in the way of revenues. So we use Entrust out of Oakland, California. They are a non-standard asset self-directed IRA company. And so it allows our partners to invest in oil and gas joint ventures, precious metals, and real estate. Just gives them a different vehicle to invest through that IRA, where a Merrill Lynch or a Charles Schwab is not set up to handle standard assets or non-standard assets. What Steve was referring to on the Roth conversion is after those K1s come out at the following year that the investment's made, those K1s reflect that the money was spent, the majority of that money that was invested was spent on drilling oil wells. So the value is significantly different on the ending capital balance than what was invested. And so if a partner decides to convert to a Roth at that point, let's say it's 10% of what they originally invested because the money was spent to drill the oil wells. If they convert that asset to a Roth in the following year, they're going to pay tax on that 10% balance, but those revenues go tax-free rather than, even if you invested in cash, you're getting 15% tax-free. So it's
wow.
You have to look at each scenario differently. But I used to be in charge of handling the IRA transactions, and every March I would get inundated with these Roth conversion requests, and I'm like, "What is going on?" And it was actually one of our partners was an ex-IRS attorney, and he's like, "Here's what's going on," and I was like, "That makes all the sense in the world." So that's just another way of participating. And ultimately, the government put this in place, with multiple tax advantages to help develop our natural resources. And when you figure that is probably, it's one of my favorite things about it is that our partners are helping produce oil and gas for our country for the most part. And when you look at, oil from Saudi Arabia, Iran, Venezuela going on these oil tankers that might burn 30 to 60,000 gallons of fuel oil a day just to get their oil to our markets, which their oil typically takes more to process than our own oil, and we produce it much cleaner than anywhere else in the country. I like all of the aspects of what we do. We give our accredited investor partners access to multiple tax advantages that aren't available in most other vehicles. We provide them with monthly revenue, and they're developing our own natural resources and promoting our energy independence.
That's amazing. I mean, I appreciate that perspective. I may be a little bit biased, but my husband retired from Nucor Steel, and that was a huge issue when he was working there. Nucor is a massive producer of steel within the United States. They actually are the largest recycler in the United States as well, and they produce the cleanest steel on the market, rebar, angle iron, all kinds of things that they're producing. And yet there was times when China was dumping that here, with massive amounts of pollution and utilizing so much to pull it into the U.S. And when our legislative groups really help support U.S. manufacturing, I do personally, politics aside, certainly promote the fact that the U.S. is supporting those industries, supporting U.S. manufacturing and development, through R&D credits. I mean, we do a lot of that as well to support companies that are doing research, doing development, keeping and paying jobs in the U.S., and really supporting the U.S. economy. And oftentimes what we produce in almost every industry is exponentially cleaner and more sustainable than anywhere else in the world.
Yeah.
And so if we can do that from a competitive price point as well, I think it's really phenomenal. And I think it's a kudos to how the United States leads the world really in terms of sustainability and energy resources.
Yeah.
So we could continue. Oh, go ahead, Steve. Do you guys have any final comments? I know I've kept you long enough, but I think the information is so fantastic.
No, we really appreciate it. No, I was just going to say that our clients, because it is new to most people, they've never done this. So my job is to keep them very well informed, updated. They have a log on to our website, a partner portal where they can see their production numbers, the reports that are posted. The day before money goes into their account, like you've experienced, Heidi, they get an email statement, very transparent on all the revenues made, everything, what the bottom line comes to their account, and just mainly to kind of, especially their first time through, hold their hand and just make them feel comfortable, because it's an unknown, like you said. It's all kind of out there as what is this all about, So we try to make it very comfortable for them.
I agree, Steve. And you've been a fantastic resource. I actually did want to pinpoint that when you were talking about the IRA. discussion, because I think that's something a lot of people need a little bit of guidance with. And I appreciate your expertise and the support you've provided to many clients with, going through that process. John?
I was just going to say, a lot of times, like you were saying, it is new to everyone. And I don't know if Steve's brought it up before, but, we do about 2 to 3. We try to do it quarterly, but winter in Colorado is something we avoid. But we do offer our partners field trips into the field, and I'll take them up, and we spend the day in the oil field, and you get your boots dirty and you wear hard hats, and we show you everything from what a pad looks like before it's got an oil derrick on it, and then through every stage of the process, so that by the end of the trip, by the end of the day, everybody is they're all oil and gas experts. And I really enjoy doing that because it's a good way. We're based in Dallas, but we have partners spread all over the country. And it's a good way for us to get to spend some time and get to know our partners field, so, and no question is a stupid question. Like I said, I learned something on every trip, but we do offer that as well.
That's fantastic. Okay. Well, I expect you guys to put me on the schedule once the snow melts, because I don't want to go in the snow. I'm a snowbird for a reason.
We'll get you on a summer trip.
Okay, sounds good. So put me on your agenda. Would love to come meet with you guys and come and see the operations, as I know my husband would be thrilled to see it all as well.
There's lots of steel out there.
Oh, good. Well, and he'll appreciate that too. He'll be inspecting it for Nucor stamps. So, hey, John, Steve, thank you so much for being on the podcast. I hope listeners enjoyed the information. I will be sharing your contact information as well as links for listeners in the show notes. So you have plenty of ways to access and contact likely Steve, who can be a great resource for helping you navigate potential investments and look and see if this may be an opportunity that could be beneficial for you. So, John, Steve, once again, thank you so much for joining us today. I wish you a fabulous afternoon.
Well, thanks. And
Thank you. I enjoyed it.
And that's a wrap on today's episode of the /Tax podcast. I hope this conversation helped demystify the oil and gas space, and it gave you clarity on how it can serve as both a strategic investment and a tax-saving powerhouse. If you're curious about how this could fit into your portfolio or your clients, check the show notes for a special access link exclusively for /Tax listeners. You'll find more resources and a direct path to connect with the team at Gulf Coast Western. Don't forget, follow the podcast, leave us a review, and if you found it valuable, we're here to help you /taxes, grow wealth, and make smarter moves every step of the way. Thank you to our sponsor, Engineered Tax Services, and thank you for listening. We'll catch you on the next episode of /Tax.